Hey guys, welcome back to the PetroNerds podcast. It is Wednesday, February 2nd, 2022. Great day. It's Groundhog's Day. So for people who love oil prices, maybe we can just keep repeating this. But it's 2/02/2022. So sure, lots of people want to get married today. This is PetroNerds podcast episode 39. And I am really honored to have a great guest today and my first private operator. Well, actually, I've had a private operator before, but the first CEO of a private company in the Permian Basin. So I'm super pumped. I have Ryan Keys with me with Triple Crown Resources. If you don't know much about them or you've tried to look something up on them, you're not going to find much because the website's limited, but the information is great. I mean, I was pulling up some wells and we're going to talk about it. I met Ryan at a Doug conference. So I'm super pumped to have him. And before I say hi to you, Ryan, and let you talk, I'm going to timestamp this with prices. And, about 20 minutes ago, WTI was 87.93. Brent was 89.26 and nat gas was 5.41. And we can certainly talk about your viewpoints of the oil market and the global oil market, which I would love to hear. But we did have an OPEC meeting and they did agree to continue with the 400,000 barrel day increase, which most people don't think they'll hit. But oil prices are relatively steady. So with that, Ryan, thank you so much for coming on the podcast.
Well, thank you. And I guess another little update from today, Punxsutawney Phil did see his shadow. So maybe we'll get 6 more weeks of oil bull market. I don't know how that works.
Yeah, I was at the rodeo in the National Western Stock Show in Denver, and it was the bull riding finals for the PBR, and they put up like a crappy little snowman, and they were like, instead of the Groundhog's Day, if the bull hits the snowman, you'll have an early spring. And I was like, okay, we definitely had an early. The bull definitely hit the snowman, so that was that snowman was dead. So happy Groundhog's Day. And life must be feeling pretty good as a private operator in Southern Midland, and you've had some nice well additions this year, or I guess in 2021. Your production's up, and oil prices are way up.
Definitely. And maybe we're at this point where it's starting to feel like it is too much of a good thing. When we start seeing oil have a good day, it's starting to get a little bit like right now would be a great time to just kind of chill out a little bit and stay in the mid 80s. Would definitely take that. I think we'd preferred it. Things
Have
get
you been listening to my podcast? It's like you're saying this. Yeah, I think do you think your colleagues and peers feel the same way? Because I would say that, when I talk to a lot of executives, a lot of CEOs, and I tell a lot of my clients that I get anxious when everyone has like this bull thesis. And I would say that the 99% of the CEOs in the business really think we're in a super cycle. And that makes me anxious because I don't think they're factoring in what if Saudi Arabia can consistently produce 12 million barrels per day? What if Russia can consistently produce 12 million barrels per day? By the way, I do believe both of them can. What if we consistently produce 12 million barrels per day? And what if we have a recession? And I think all those are very highly likely. And it's not that oil prices crash, but they could come down from the levels that they're at.
Oh, definitely. And yeah, the recession is there, and we've got just ridiculous volatility, and whatever index you look at, and there's the perma bears wherever you look, whether it's on Wall Street Journal or Twitter. There's some people it's just perma bear. It's just like, oh, the market's going to crash tomorrow. At some point they're going to be right. I mean, we've had a ridiculous run and demand destruction via just a recession or correction. I mean, that's entirely possible. Economy's juiced. We're on steroids, but I mean, that's got to run out at some point. And, not as much fiscal stimulus to put our economy on steroids. And then, we've got the inflation thing going on. And this is a lot of unpredictable, just a lot of variables. I think we'd rather actually have $75 a barrel than 120 from our business standpoint. That's a nice middle ground to make sure there isn't oil demand destruction, yet the economy stays healthy. We've got one of the major themes, and you've talked about it on your podcast before, is just the inflation. Our cost inputs have gone up substantially. It's usually okay with with rising commodity prices, but the rate at which they're rising, and we could speak candidly on this. I can speak candidly. We're private operator. We don't really have to push a narrative. They're going up. I don't know where these reports are coming from, where the capex numbers are going to stay flat to going down maybe in 2022 versus 2021. I don't know how that's possible, but maybe they're a lot more creative than I am. Just literally today, as talking to our SVP of operations, cement. Everyone uses cement. You drill a well, you need cement. That went up 10% just in the last week. And one of the other things is you drill a well, or even just PDP. You use a lot of diesel and oil and gas. That is one of our major costs, is the energy we produce. So yes, we're getting more revenue, but costs go up because we're a huge consumer of diesel, gasoline, and natural gas to run our compressor stations and everything else. So.
Well, I think that's a huge, and I want to keep talking about the inflation piece, and I don't mean to cut you off, but I think that the cement and diesel, and being candid like that, of saying 10% increase, and I sort of just want to frame that a little bit in thinking, and I know we're probably pushing, I'd say, about 150 rigs for private operators and about 150 rigs actually for public operators. You guys have one rig running, correct?
That is correct.
Awesome. Well, so you have one rig running. So we have about 22 public companies running these 150 rigs. And then we've got over 50 private operators running these 150 rigs. So we have a ton of private operators running this. And I do think you're right that these public companies, and I haven't got into, listening to all the earnings calls just yet. I was listening to, I think ConocoPhillips was out today. I just had, Aaron Hunter on the podcast with ConocoPhillips. So we were talking about the public's perspective right before the earnings call. And I would say, I think the public's and not necessarily them, but other earnings calls, the previous ones I've been listening to, Halliburton and Schlumberger, there's there's downplaying in the inflation piece. And I think obviously they want to downplay that because, they don't want to emphasize that for sure, because prices are good and things look great. And I know at least last quarter, there was a big trend and theme of at strip, and that always drove me a little crazy because strip prices were great. But then and I keep reminding people, we saw $62 oil about a month ago, or just over a month ago. So yes, we're at 87 and we've been touching the 89 and Brent's been above 90, but it is this uncomfortable territory where it's very geopolitically driven. It's very risk. There's a lot of risk in the market, and it's less sort of demand growth driven. And I think these inflationary pieces, which if you're listening to earnings call, Starbucks, people said it's not as big a deal, but they did have a 14% sales drop in China, and they talked about inflation and the inability to get people, their sales were okay in the US, but their inability to get people, to work in the stores, and the inflationary aspects were huge. And I think, if people start, as inflation bites, those become, that's an item that you don't buy every day for yourself. And so I think in the industry in particular, it just sort of makes me think of, we don't hear as candidly from these public operators of exactly what the inflation is. We hear about how they're going to offset that with efficiency gains and certainly longer laterals and speed and everything. But it does, I think, put a lot of pressure on. It does certainly put pressure on private operators. And I don't, not sure if you want to talk about your hedging profile or if you're allowed to. But, hedging, I think it is relevant for private operators. And I'm even okay hearing, 6 handles sound great to me, because you can make money at that. It's a little bit harder with the inflationary piece. But then again, this is the why I kind of want to, beat the dead horse on this inflation piece, is because it gets into the, how you actually work with service companies and, what kind of pricing power do you have? And if you're smaller, I feel like collectively you're doing a lot of damage, but it's harder as a tiny company to sort of just demand, you're not locking things in, necessarily frac spread for a long period of time. It might be a little more lumpy. And that did change a lot during the COVID period. So, with that rant, I'll sort of let you just jump back in. Sorry about that.
Yeah, no, the first thing, one of the things you just mentioned was the inability to get people. Starbucks and China, but that's everywhere. It's in the oil field too. Compared to last year, there's a lot of inexperience, and those wages have to rise to get people to come back. And a lot of people have said, screw it, I'm never going back to oil and gas. It's too volatile. So this is what volatility does. It creates these inefficiencies. So our service companies with whom we have really good relationships have had a lot of turnover because that demand has just skyrocketed in the last 12 months. So the people, the average experience on a rig or on a frac crew or workover rig or whatever has gone down substantially. And so that's actually another form, very sneaky form of inflation in our development budget. It's the raw materials. We already talked about that, but this one is performance driven. Like it's going to take an extra half a day or a day on average to drill a well. It's just inefficiencies built in by the lack of people. We're spread too thin. So that's definitely hit us, and we've tried to project that as much as we can. But when things are this volatile, it's very unpredictable.
Yeah, and when you say that week over week cement price increase, now is that reflective of one? You're not? And I'm not familiar with how the contracting structure would work on if you can lock in cement prices, but what, a big 10% jump like that, is that because everybody's jumping up that activity and it's corresponding at the beginning of the year, and also people are probably seeing the same thing, freaking out a little bit and just trying to get it locked in? Or is it, this just normal volatility? I mean, that does seem like a significant week over week jump.
It is massive. I don't know particularly what caused this, but I would imagine it's people locking in supply, no longer running off the spot market. Maybe there are a lot of folks locking in 12 month contracts, and the suppliers saying, "Look, I mean, it's supply and demand. It's fair." We just physically can't buy cement at the same price we could a month ago. It's just not there at that price. So,
and with that many private operators running and gunning, it would make sense that maybe that's yes. That snap.
Yes, exactly. And then you mentioned who's the source of growth. I mean, certainly private operators. You got Endeavor, Mewburn, and Colgate, and a few others, but they're just that's a big source of the growth. But at the other end of the spectrum, the biggest publics, you've got Chevron and Exxon growing like crazy. Exxon just announced yesterday they're going to grow their production out of the Permian Basin by 25% this year. That is a stunning amount of growth, and they're a big producer. And they're not doing it with as many rigs as they were running before COVID, and neither is Chevron. But I mean, that's a stunning amount of growth and a lot more CapEx than they spent last year. So you got these kind of barbells at both ends of the spectrum, the bigger privates and then, the super majors. And what will really make it go out of control is if the independents not lose their discipline, but, decide to, chase the value proposition of growth, which is starting to be rewarded. Once Exxon announced that they were growing a little bit, their stock went up. Okay, that's an incentive to grow. And is that returning en masse for everyone? I hope not. But we'll see what the big independents in the Permian Basin do, and if they lose their discipline, all bets are off. Things are going to get really, really crazy out there and real tight.
Well, and that's super. That's a really fascinating thing. And I like I said, I did ConocoPhillips and was catching up. I had a webinar this morning on the energy crisis in Europe with my old boss in the Global Gas Center. So that was fun. But the growth. So the fact that Exxon and Chevron are willing to increase output, right, and they're getting rewarded for it, I do think it's interesting because it's the timing of the market. So it's this massive pandering to investors that everyone's doing, and really. You should have, in many ways, some folks should have been increasing output last year. But if you're public and you're not getting rewarded for it, then it makes sense. And if Chevron and Exxon are getting rewarded for it, and the reason they're getting rewarded for it is because tech doesn't look so great. We're just hearing Spotify and we're hearing, PayPal, and all these earnings don't look amazing. And every tech person is trying to, make it sound, like it's not the end of the world. Peloton's all these companies are not doing great. This was not rocket science. These companies did well when you're all locked in your homes. Nobody wants to be locked in their homes anymore. They're not going to do the same. And you have rising interest rates, and it's just going to flip. So, I mean, the actual shareholder or the performance is saying that the market's saying, hey, oil and gas looks pretty good. It's a nice little inflationary hedge. Prices are going up. So I think it's a timing, and you're right. It could be a very messy perfect storm within the Permian from an activity standpoint. And I question on exactly what that production growth, because Exxon and Chevron have kept their rigs alarmingly flat and low. And I was talking with Conoco last week, and it was they went from 20 rigs to 10 rigs and have kept it steady at 10 rigs. However, they bought Concho Resources and they bought Shell's Permian assets, so they're gonna move. They're going to be doing something with them, right? They're not just going to sit on it forever. And they've really beat the drum to the market of saying, no, we're not going to grow. And no, we're all ESG friendly. And we've got this triple mandate, and we're into the Paris Accords for the 2050 net zero agreement. But, oh, by the way, we bought 2 big assets. They're going to do something with those assets. And I think the same, for Chevron and Exxon, is that the Permian is a flex mode, right? They can actually move the needle on it, and they can add production. And when you're getting pressure to pay for all this ESG stuff, and you have to invest 2% of your capex at $90 oil into wind and solar, which doesn't return on the money, and will increasingly return less on your money, you may try to produce a little more oil to pay for that. That might be logical.
Yep. Yeah, exactly. High margin can then maybe reinvest in low margin, but anyway, that we get. You probably have had a lot of opinions over the last year about the super majors turning into energy companies, and basically investing into what very, very high valuations. I mean, those your renewables businesses and assets being valued at some really big multiples, and I guess those multiples could still increase, and but it seems a little frothy.
It's frothy and squishy, and I love that you've taken me completely off our roadmap of what we were going to talk about, which is great, because it's actually, you bet you were more difficult to have as a guest than anyone, because there wasn't much I could prep for except for your production data, and I think for listeners it's fantastic. So I love talking about this stuff, and would love your input.
Yeah.
So I think that squishiness, and that I personally do not think, and I don't know how many PetroNerds podcasts you've listened to, but I'm very much on the record for saying no, it's crap. And if you could have made the case a year ago that you might have gotten a little bit of return on some of these solar and wind projects, a little bit, and it was thin. And even then, BP was getting hammered because they were paying astronomical prices for, which they wouldn't disclose, for just offshore acreage, for offshore wind. And then it, just like shale, it's like, what did you pay for the acreage, and can you deliver on it? So, I mean, they were getting pressured then, and now I think the margins are thin, and with inflation, and it's not a dead horse. Got to keep beating it, because the inflation piece is very real across the energy industry, across every industry, and it's very, very real in solar and wind and green tech. And nothing hits tech and green tech more than higher interest rates. And you have to have a political climate that's really willing. And this morning, when I did this webinar with the Energy Policy Research Foundation and the Global Gas Center, it was on sort of the Texas grid in California, and it was on the energy crisis in Europe. And I moderated the panel on the energy crisis in Europe, and it was a really fascinating discussion, because this is you have many pieces at play, and this inflationary piece, and where the European Central Bank stands on inflation and interest rates and energy, and the energy transition is really, really serious, because they want to look through the energy transition. They want to allow interest rates to rise, and they want keep interest rates low so they can allow the energy transition to happen. And they keep saying, and we heard somebody on the panel say, hey, Germans, the people in Germany are okay with these high prices. And I kind of call BS on that, because I think at some point, when they can't, and the European Central Bank is saying people aren't turning up their thermostats adequately because they can't afford it. So that, to me, tells me they're not exactly happy with the highest energy prices in the world. And politics, at least here in the U.S., are going to come home to roost come November and the next presidential election cycle.
Sure. And this is one really such an interesting topic, but people talk about your return on investment and economic metrics, but there's an even simpler one, which is, to produce energy, to create energy for our economy, we have to sink energy into creating it, and it's just simple thermodynamics. It's a shale well in the Wolfcamp well, horizontal in the Permian Basin, takes 1 unit of energy to create 20 or 30 units of energy over its entire life cycle. Wind might be about 12 to 1, and solar is probably 6 or 7 to 1. So when when you need to basically, create the same amount of energy for society, for our standard of living, and a lot more of that has to go into actually producing the energy, and therefore there's less energy to spread around to the rest of the economy. It's like the analogy I like to use is, if you're a hunter gatherer, and we still have to play by the laws of physics and thermodynamics, would you rather spend an hour a day hunting a deer, or 10 hours a day, hunting little birds and rabbits and lizards? That's how much time is liberated if you put 1 hour a day to feeding your entire village or something, versus 10 hours a day just feeding yourself. One is wealthy, one is poor, and it's worrisome. Going so fast, you have to have a wealthy society to achieve an energy transition. You've got to do it slowly. Otherwise, you're going to introduce so many shocks. And I know you've said this all over the place on your podcast numerous times, but this is too fast, and this is coming. And personally, we do need an energy transition. It just has to be on the order of decades, maybe a century.
Called an actual transition, not we decided in
evolution.
In a year and yes, that we'll flip the switch. That being said, I guess, and those are great points, and I appreciate that. But can you? Are you guys as a private entity? And I ask this because I work with a lot of private companies and private equity and in various entities. But I think it's great for listeners to actually hear. Are you guys on a executive level, on a board level? Are you guys thinking about these issues? Like, are you talking about, how people are investing, what the global macro looks like? Are you taking this into account when you're putting the drill bit into the ground in, I'm going to pronounce it, Erie County?
Yes, Erie County. And we definitely are. And, there are, some of these ESG initiatives, they're, it's so polarizing. We really embrace a few of them because they make really good economic sense, and it's just kind of a choice to view them as projects. So I've been pretty vocal in various other forums about our capturing methane should be profitable, and it has been for us. It's been out of all of our projects last year, capturing our methane had the best return on investment, and second place wasn't even close. We spent about $130,000 all in detecting and fixing our methane leaks. And from that $130,000 investment, we captured about $1.6 million of additional gas and natural gas liquids.
Wow,
and
that's a very good,
fantastic ROI.
That's a really good metric. And I think so many people, we hear over and over about methane. And methane's a good thing to capture anyway, but I think no one's put a dollar amount on my podcast of what they've spent and what they've actually gotten back. That's awesome. That's a great number.
Yeah. And it's not really that we're smarter or better at it. It's just like we just made it a priority, and we're viewing it. We made the choice to view it as a profit center, as an opportunity, and rank it amongst our other projects. So if you just apply old school, F&D cost, like the cheapest gas and NGLs we can find, the cheapest hydrocarbons we can find are leaks. Let's fix those. And of course that doesn't scale. Once you fix your leaks, you move on. But in the meantime, we've lowered our methane emissions by about 90%.
Now, can I just ask why that, from that math, that easy math there of what it costs to actually reduce that methane and fix the leaks and how much money you got back on the NGL. So if you could repeat those numbers, why wasn't that done before? Just wasn't on the radar, just wasn't thought to be done. And I grew up around the private business, so I'm kind of baiting you because I know I think I know some answers, but I would love to know your perspective why that wasn't done before.
There's one of the main reasons are we have regulation and guidelines from the EPA, and this is Quad OA, and we have these. Operators have had to disclose their emissions and their carbon intensity for many years now, but it's through what are called emissions factors. It's basically just you give in a spreadsheet, you describe the type of equipment, you have. And there are these emissions factors, like for pneumatic controllers and everything else, that it's a theoretical number. So you describe your assets, put it in a spreadsheet, it spits out this methane intensity number that's not actually measuring anything. So we went by that number of what we were theoretically leaking per the EPA's recommendation. We were negligible. We were one of the, as far as we could tell, the best in the basin. We have VRUs and basically everything the EPA recommends, like we have, and so it's almost a perverse incentive. Once we actually measured our leaks, we were 15, 20 times higher than what the EPA emissions factors were saying. And again, we can say this. I can say this because we're a private operator. A public probably can't say that. Because their investors might freak out. But this is true for a lot of people. This is true for a lot of operators. It's out there, and you can choose to look at the old emissions factors, but
it is
the
fixable.
EPA will adopt is in the process of adopting new technology where you actually measure. And we're going to have within a year a satellite flying over the Permian Basin once a day, basically disclosing everyone's. It's backed by the Environmental Defense Fund.
I'm sure it is.
Basically making public this data. So this is something we all got to get ahead of.
Right, but that it's fixable, and that's what I push people on. It's something that methane links are fixable. Now, how in which they go after your CO2 footprint. That's a different story, and it's not that I don't want people to do this, because these are fixable things. You do get a return on investment. It's a good thing to do. I just I get a little hesitant of it's a Pandora's box, and it's sort of like opening up the. If especially when the Environmental Defense Fund is involved with the EPA, then it's like, well, what's your next step? Once you've done it, are they going to let you have a pass, or are they going to go after something else to try to put you out of business? And I think that's important for the industry to recognize, is that as leaders in the industry, to make it clear we're doing this because it makes sense and we'll do this. And it makes good business sense, makes good economic sense. It's also the right thing to do. But you're taking it a step too far if, on the next levels. And I think industry leaders do need to get ahead of that and make sure they're clear on how far they can actually take this, and that this production is, it is really meaningful, of producing stuff in the U.S., of having, not sending the dollars abroad, keeping the crude here and using it here has a significantly lower CO2 footprint, if indeed this is about CO2, which I've argued many times it's not. But I mean, I just think that's important to put in perspective. But awesome numbers, and very, very good perspective, and really nice to hear from a private operator, because you're right, we don't hear candidly from the public what's actually happening on that side.
Yeah, exactly. So I guess getting on the original question, which is there's certain ESG metrics which make all kinds of sense to be good at, and the methane intensity is one. Water recycling, another one. Another one is just simply like just your recordable incidents. Let's just be safe and not have any injuries on the out in the field. I mean, these are things that everyone should want. Everyone on the planet should want these. Everyone's aligned on wanting these things to happen. Let's just be good at them, and it's something we track. And if we can stay ahead of the game, I mean that's going to improve our ability to attract capital, and ultimately, whenever that may happen, an exit, and it might be a while before we exit. So it's important to a critical mass of investors who do think some of this stuff does matter, and it does. So that those focusing on the E part.
I think that's fantastic. Well, and I actually think you're probably focusing, if you're talking about methane, water recycling, and incidents, you're focusing on S and G, not just the E. So I think that's good. But that kind of begs the question, and I do want to get into the numbers of your operations and stuff, which I have here because I am a nerd and I went and pulled them up. But I'm going to rewind for just 1 second because Ryan is actually he has a background in banking and reservoir engineering. So you have a little bit of a unique background for a CEO, which I thought was very cool. About with Jefferies and different energy investment banking at Jefferies, reservoir background, and now the CEO of Triple Crown. And Triple Crown has backing by Yorktown Partners. The reason I bring that up is because that you talk about where you go next with the business, right? And you guys have about 40,000 acres. I think you said you're the acquisition was in, you started the business in 2017 and then really started acquired the assets in 2018. So you've been at this since 2017 with the company, right?
Yes.
Okay. So 2017. Exactly. And then if I'm looking at your well profile from 2017 to now, I mean, you guys did have the big bump in 2019 with 20 wells. And then you dropped down to 10 wells in 2020, and you have 11 wells on the books right now for 2021 through Enverus. And the well performance for 2021 does look really good. I mean, you significantly outperformed. I was normalizing and everything. The wells look really good. So, I mean, I guess just before we get into the numbers and the nerdiness with that, I'm curious as to, 40,000 acres. The wells look good. I think it's 177 wells I'm seeing on the books, about 8,000 barrels of oil a day, 16,000 barrel of oil equivalent per day. I mean, you're in the southern part of the Midland. I mean, off the radar, it seems like a nice, this is a great little asset.
Yes, it is.
I don't mean to say little in a demeaning way.
I mean, look, you hosted, the next, previous weeks, next couple of weeks, you're talking to some companies who are a whole lot bigger. So, relatively speaking, we are small. But, we love our little, our little neighborhood. Southern Midland Basin is, said this before, but it's kind of the ghetto of the Permian. It just a lot of folks have really poor impression of the drilling economics in the Southern Midland. It's just the ground zero for the bubble point death, all that stuff from a few years ago. So we weren't scared of it. It's not all homogenous. I mean, there's 1.5 million acres in the Southern Midland Basin, depending on where you draw the line. So it's our wells don't look like Midland County or Eddy or Lee County. And that's okay. Like it's shallower. It's a little bit more gassy, and these things turn a lot of people off, but it's also a lot cheaper to operate.
If it's if you're lower well cost, about range, what depth and what formation are you in?
It's predominantly Wolfcamp. We have just a huge that everyone in the Permian does, but the top of the Wolfcamp A to the bottom of the C is about 1,000 feet. So we have two primary targets, and depending on where we are, three other targets, but. Like you mentioned, with well spacing, we don't want to get too tight. Same with a lot of other operators have been moving to in the last 3 years or so, and just capital efficiency. We can sacrifice some inventory off the back end of the drilling order if it's theoretically happens 10 years out to improve our capital efficiency right now, and that's. We're doing it for the same reason everyone else is. So yes, we have less inventory than we did per section or per unit. But
not that much else. I mean, we were talking offline before because I was just looking at that significant well performance increase that was normalized, and it was great for 2021. And seeing that there was a little upspacing there, and not massive upspacing. I mean, it wasn't. Some of it seems a little bit more than others, and there you looked like you were doing kind of some testing with the spacing when I was looking at these laterals on Enverus. But I mean, I kind of would push people. I always want to know. You were seeing this performance bump, with this spacing. We definitely saw it, and no public companies don't really want to talk about the nerdy stuff anymore. They don't want to talk about the spacing. But I mean, if you're going from 600 foot to 900 foot, you're losing. I'm more would advocate more for something slicing the difference or taking 200 instead of 300 foot. And it seems like in some areas you're doing that. Are you guys settled on the nerd side of the business? I mean, I think in my previous podcast with ConocoPhillips, we talked about all these good things about the Midland, and we didn't talk about obviously the Southern Midland, but the Midland Basin has a lot to offer in that it is more delineated, it is well understood, it is shallower, it is easy to drill. It's all the reasons it was quite resilient in the last couple of years. And I would say even where you're at, I love I would love where you're at, and people are not looking, and you sort of have, you can play around in the space because other people don't like it. But I would love from the nerd perspective of, the spacing and stuff. Are you guys settled? Like, this is what we're going to do. This is it. We have a cookie cutter completion design and we're just going to go for it. Or given the fact that, in your liquids has kind of seemed up and down. So, I mean, given all that, it seems like you probably would still be tinkering a little bit.
Yes. And we're, the spacing, all else equal, kind of should be a function of commodity price. What are your financial goals? Back in 2019, you mentioned we were a little tighter. Our wells were paying out in a little over a year. And fast forward to today, it's less than that. This, we have to also factor in the service cost inflation that we previously discussed. But we're erring on the side of a little bit looser in maximizing that capital efficiency. We love beating production guidance, just like everyone else does. So underwrite a pretty conservative type curve, and then if you have conservative spacing, you're probably going to beat it. And that's what we've been.
And you do see that in your first 3 month and first 6 month significantly. So I mean, that it went down from 2017 and then consistently back up and way up in 2021. So I mean, I can see the logic in it. It's always sad to me when I'm like, the wells are, I was that tight well spacing, and then the wells being gone. But I also think I think probably people don't really appreciate that. I guess we could call it real oil prices, but what is your real price after inflation? And if you're paying a little bit more than other, whatever it is, it's important to realize that. So yeah, $90 oil, in theory, you could have tighter well spacing, but actually you may not want to, given all the cost inflation and given how quickly you want that payoff, and what are the metrics of your business, and what are your success points that you're trying to hit? And I think that's different that is different for every operator. Or can be different for every operator.
It certainly is, and we bought our entrance into the basin was of intermediate maturity, and then this was in early 2018 when not very many things in the Permian Basin were very mature. Well delineated, good infrastructure, and the business model was, and at our founding, live within cash flow, pay down debt, and it was a lower risk equity value proposition, and it still is. So we've had that model for 4 years, and that's precisely it. I mean, keep our reinvestment rate as low as possible. That 2019 we grew production over 2018. It's mostly because we had a lull in activity in 2018. That's when we were wrapping our arms and heads around what we just acquired and digesting it. So we didn't get out of the gate blowing and going or anything. So 2019 did have quite a good amount of development. 2020 before COVID was going to be like a much lower reinvestment rate, create that nice production base and generate a lot of free cash flow. And then COVID hit. And that obviously changed things. We did live within cash flow that year. You mentioned 10 wells, and I know you want to talk about this. When we had a good hedge book, a very good hedge book, and we
so in 2020 in 2020 you were decently hedged.
Yes.
Yeah, and that's a game-changing factor for, I was just talking with a couple folks, different companies the other day, and that is a really big one. I brought it up in the context of where oil prices are at now, and the confidence I'm hearing from all these CEOs, and I certainly heard that same confidence at the beginning of January 2020. I think I even spoke at a Doug conference, and I think I told them, hey, y'all thought oil prices were going to 80 because we saw 60, and when we see 50, you think they're going to 40, and obviously they did go to 40 and lower, but I think people probably didn't really appreciate that. Many people that should have understood in January 2020 that the strength in oil prices was not from demand, it was from supply shocks, which weren't actually real. They were just sort of fear driven. And I think right now we're certainly seeing some of these fears from the geopolitics side. So, but I think it's the clarity that people have when they see these numbers of sort of what you did during the downturn and everything, and the fact that you even did 10 wells in 2020, that's fantastic. So having a good hedge book and being in a good position, that probably also put you in a great relationship with your private equity backers, and just the ability to keep things humming and not shut everything down and freak out.
Exactly. And there are a lot of opinions on hedging and what it's for, when you hedge, how much, and it just depends on one's goal. And there are a lot of companies, usually small cap oil and gas companies whose investors primarily are um, are investors who want a levered play on oil price, and that's the easiest way to do it. Go buy an oil company. It's you get higher beta on the price movement in the oil company than you do on oil itself. Often, although that seemed to have disconnected in the last couple of months, and we can get into that too. Really interesting dynamic there. But we're in this to make money. Our investors are in this to make cash on cash returns. So we underwrite projects. We know what our wells cost. We know within a pretty tight window what they're going to produce. The last variable there is price. What do we get? And once we reach final investment decision on planning a well or a pad, 4 to 6 well pad, we hedge the production in before they're even producing. Or at least a percentage of it. And what that does is, right now that means our hedges are underwater. It's like, okay, if you're playing Monday morning quarterback, you can say like, oh God, you shouldn't have done that. It's like, okay, well, that's exactly what we did in February of 2020, and it kept us very comfortable during the worst oil price crash in history. It's we when we're spending capital, and it's not our capital, we want to guarantee a return on that capital. And so when we like the prices, we just hedge, take that variable, just get rid of it, and lock it in to the extent that we can. So that's how we'll be for the foreseeable future.
I think that's extremely honest, and I really appreciate the color on that, especially for the listeners, because I think hedging it's a unique thing, as you say, and a lot of folks do it for different reasons. And that there should be some very clear reasons in which you do it. Lots of individual CEOs hedge, everybody has a different wonky strategy on how they feel about hedging, how they don't. Harold Hamm was famous for selling off his hedges when he shouldn't have in 2014, and having very strong, and those hedges are often related to very macro views, right? I mean, macro views. And this is where I do really pitch a lot of companies on what my services and what I do in advising. And that those macro views really do matter, because they do funnel into your business decisions. And so you guys seem to have as a private company, you sort of have a unique position, and that you have that sort of sorted. That's why I was pushing a little bit on how you guys think about the macro. But if you can have a backer that's okay saying, okay, you hedge at this. Yes, you might be underwater, but I'm getting this return, so I can be steady. It also takes a massive amount of anxiety in just the day-to-day business. And I mean, I imagine it's hard because you do have these inflationary pressures, which I think are extremely real. So, making sure your costs are in line. I mean, you can hedge out oil prices, and that, but you can't control the inflationary aspects. And especially if you don't have the labor or the people, and you have these offsets, or something takes longer, that's all problematic. But the ability to be hedged and to not have a monkey on your back from a private equity player constantly asking and beating the drum. I think a lot of companies were, we don't hear from a lot of private companies, so we won't hear that. But my understanding is that monkey was very, very, in addition to the ESG monkey, now the private equity monkey on the back of all these guys and making them hedge at a four handle was crazy and ridiculous, and frankly, it was just wrong to make companies hedge at a four handle. But I mean, that's the reality. And so for you guys to be able to, even if you're underwater on your hedges, and we can talk about the gas side, if you're comfortable drilling at the level you're drilling and completing, and your backers are with you, I think that goes a long way in terms of just the steadiness and the ability to do business. And that also has a meaning for all of other private companies are doing that. It means that the private operators are not going to be quite as volatile or drop like a stone, if prices were to drop 10, 20, $30.
Yeah. Exactly. Yeah, there's it really allowed us to drill our hedge settlements in 2020. It funded part of our development because we knew we were coming back out of it. We didn't know when, but at that point, service costs had gone down, and it was like, okay, look, we can actually make money here our wells have a reasonable return at $35-$40 a barrel. It's okay. Well, let's go ahead and do this. At that point, we had some other input about how much we should be hedging. So, at that point, that was really the fall of 2020 was probably the worst of it as far as the capital markets went. Banks really just flaying the sector. The
that's where I think banks, is that really with the height of that push of the four handle stuff of when the banks are fleeing and everybody's just trying to secure everything, and it's a bit Bananaville and everybody running around like chickens with their heads cut off. And
yes, and they have to protect their investment too, and I understand where they were coming from. There's also this. It depending on the company, where if you force your business, if you lend an oil and gas company money, and there are a few of these that happened in June and July when we were in the 20s. Okay, you force companies to hedge in the 20s. You're basically guaranteeing Chapter 11 at some point.
Yeah.
Whereas if they did not hedge, at least they'd have a chance to get out of it. Right. So that really didn't make any sense. But
no, and that it's point, beyond. So why? Beyond it didn't make sense, and the four handles didn't. I mean, I always hear from certain private equity guys. I think Chuck Yates has mentioned it to me too. Like but we had to do this, and it's all about private equity doesn't make money the way people think they make money, and all these things. But it's like I could pull, and I did it for clients, I did it for folks I was working with. But it was just a U.S. supply and demand chart, product supplied. Like you can put prices next to U.S. supply and demand. And it was very simple. It could not stay in the 40s. The demand levels were not sustainable, and the gasoline demand was rising up. Now, I do believe that the banks and private equity were heavily influenced by people who didn't understand the oil market. And I dealt with a lot of those people who were in the oil market and still believed they knew everything. And they would say jet fuel demand will never come back. It can never return to pre-COVID levels because we've fundamentally altered, the economy. And I'm like, this is ridiculous because we're offsetting as we speak and people's behaviors change. Well, we debunked that theory incredibly in the US because everyone drove like crazy. And we had, record gasoline demand on July 4th of this year at over 10 million barrels per day. And December of this year, we had 23 million barrels a day of demand in the US. And those are record high levels. So we more than offset it without going back to international travel to Asia with having, and we're nearing these pre-COVID levels of demand. So it was a narrow view that reminded me a lot of sort of 2014 when when we were coming out of it and talking about inventory levels and shortfalls of investment and then production pops again. It reminded me of sort of that it was a very, very narrow thinking of the people just can't adapt and that demand wouldn't go up. And so I wonder if that had a lot to do in influencing how people were, hell bent on the 40s, in addition to just trying to save face or whatever. The 20s doesn't make any sense to me.
Yeah. Yeah. And those, when you have a strong opinion that begins with either always or never or some absolute, that's just usually an immediate like, ooh, I don't. When yes. Something that's rigid, black or white, like I don't think I'm gonna really follow that or agree with it completely. No, I agreed with that, and that. Hedging at 40, and this is October, November, and that was right around the point of bank redeterminations, and banks had a lot of leverage then. Capital fleeing the industry. It's a lot of that still hasn't come back, and it'll come back when we start en masse generating the types of returns that we've promised, and that we're showing we can deliver right now, but. Right now, there's still a capital shortage. There's no shortage of good locations or good assets, but we have a capital shortage and then aforementioned people shortage. But so they had leverage. Banks had leverage if you're in the space, and still do on getting the terms that, at a bare minimum, they think protect them, protect their investment, and
even if they're
acting
wrong.
what they believe is
Right. And I think those banks, and I want to interrupt you because I want to get into this, the access to capital and the sort of the where things go. So you brought up a really good point, and I just don't want to lose it. But the sort of access to capital, because I get a lot of people asking me and talking about, does the business, the last 2 years, that's what the doomsayers would say from abroad, from the Middle East, in London and stuff, was that, the access to capital is just going to dry up. And frankly, they've actually been saying this for several years, that you just wouldn't have the access to capital. And you could see things like Haynes and Boone does their surveys, and you would see that this new category would pop up, and it would say they would do a survey of where folks would be getting their money, and it would be like public space. Obviously that went down to nothing, and then it would be from operations. So companies were actually making enough money that they could source their capital from the actual operations. And then a new category popped up, and it wasn't private equity; it was private capital. And I think that private capital, and I think it's very, probably more Permian centric. But I think that private capital and that is interesting to me, because I think some private money is able to look through the always and never and a lot of the BS that's frankly in the market of people just saying, this is how it is. And they can look through it and say, yeah, I'm betting on oil and gas in the future, which I'd bet my money all day long on, because that's where it will still be there. We will still be using it. And so I'm curious on your thoughts on that access to capital. And I know you don't have to speak at it from your perspective, backed by Yorktown and stuff, but I mean, you are a private player, and people do ask a lot, are these private players going to have the access to capital to drill? And I think at that Doug conference, we were at, and everybody at my table who probably wanted to kill me because I was arguing with all the gentlemen quite a bit at the speakers dinner. There was a theme that was trending, and this was that was that was July of last year at the Doug Permian conference, Heart Energy's conference. And I would say that, everybody was running around and crazy and excited, and people were together, and there's 3,000 people at that conference. It was great. But they all said the sort of same thing to me. Every CEO was saying the same thing, which was, we raised the money and we're drilling and we're going to be great, but we're going to be the only ones, and we're not going to have enough production is going to fall short. And I thought, well, you're all here and you're all doing this, and you got frac sand guys, frac sand booths back. So the business seems to be back in earnest. And I just noticed that it seemed like they were able to access that capital. Might not have been as easy. And certainly now when we're seeing the rig count growth with the privates and just the sheer activity of privates, the access to capital seems to be there. And I'm curious of your thoughts of that, what role ESG plays in that and things like that. But you're getting it. Whether some of them were forced and just don't know how to leave might be a factor of it, but the growth isn't that. The growth in it, there's more to it than that. The actual, up ramp in private operators across the U.S. dominating the publics, there's something to that. I mean, it's oil prices, but they're able to get the capital, it looks like.
Yes, and there's with the consolidation, especially the bigger, more established privates. There's a bifurcation there and a bimodal distribution. They're the smaller companies, a lot of which are might not have ever been able to generate the scale. Maybe great assets, great people, but just for whatever reasons couldn't get to that scale. So that's still prevalent, both public and private. That there's just a critical mass, and just having some track record of being able to being a competent operator, at a critical mass to attract investment. So the scale is still very much a factor. And we started off talking about some ESG stuff, and that's important up to a point for a lot of investors. There are some pragmatists in our country who are probably staying away from oil and gas. Maybe it's because of a poor history of returns, and not as much as the narrative that the negative environmental narrative, whether that's well deserved or not. But might be sitting on the sideline just waiting for something like, okay, here's some companies. If American and Canadian oil and gas companies can prove, we're lowering methane emissions, our carbon emissions are going down, Scope 1 and Scope 2. We're recycling a lot of water. We're doing things sustainably, and we're delivering free cash flow and returns. there's a massive middle ground there who's going to just, whether it's individuals or institutions, that it is going to pile back
Absolutely.
into oil and gas. It seems to be happening some right now. You're seeing some signs of that in the bigger companies. But that bifurcation still exists. If you look at multiples, trading multiples, whether it's cash flow or free cash flow yield or whatever it is, there's a point at which it just scale gets you another full term on your EBITDA multiple. And based on our analysis, it's somewhere around $10 billion. That's enterprise value. And that seems to be big enough, safe enough for the institutions and the individuals who want to rotate back in and invest in equities. And that's only part of it. The debt is also interesting.
Yes.
This is the commercial banks, the big ones whose names we all recognize. You have branches on every corner. They pulled out. They've decreased their exposure and probably overshot their goal. There's a few of them want to actually put money back to work, but the type of credit profile that's being funded right now with bank debt is so much more strict right now than it was 3 or 4 years ago. And there still is not enough of that to go around to with perfectly financially healthy companies. So private capital has filled that space a little bit. A lot of folks are going a lot more to the high yield market. But that, again, needs scale. You need scale to do that. The minimum high yield debt investment, it's going to be about $300 or $400 million. You've got to generate a lot of cash flow to have the leverage profile that those investors are going to like. So again, it's this scale theme that, if anything, in the last month is just it's at an all-time high. This bifurcation of big versus small.
And I love the bifurcation because I use the word a lot when I'm talking about the public privates, and I think you have to break out the publics, and you have to break out the bigger independents and the smaller independents, and you have to chunk everything up to really look at them. And this is where I really do think that the OPEC is probably going to miss. Is really going to miss what's going on here. People are already missing it. Real good analysts on the oil market are truly not understanding what's happening in the U.S. right now. They don't understand what you're doing, how resilient you've been. They don't understand all the stuff we've talked about. They will once they listen to the podcast. But that being said, it's serious because I think that there's this sort of resiliency. I do think you're right that money it has a reason to come back, and there is a story, and it may not be globally. I don't think it's globally, but in the U.S. and Canada in particular, I think you're right, is that, there is a story for equities, to come back to oil and gas from the inflationary piece, just the strength of oil price. I actually think gas prices are very relevant in this too. The strength of the gas market and the fact that, gas demand is will only go one direction up. And people say that it won't, if you're following the International Energy Agency or others, but the reality is it's going to have to. It simply will. So gas and the ability we will have to increase exports out of the U.S. Exports will have to be increased out of Canada. And the narrative and the policies sort of look like it can't be done. But policies are not... They may seem stagnant in Europe, but they are not stagnant in the U.S. And I remind listeners all the time that we were not in the Paris Climate Accords until January of 2021. And we did not have an executive order on climate change until January of 2021. So if you think that this stuff can't be reversed, I know people don't want to hear it because it may not feel comfortable, but it can be reversed. And I think that the November elections could reverse some of it, at least the sort of tailwinds behind a lot of the ESG green stuff. I think some of those tailwinds the wind could be taken out of the sails a little bit in the midterms. And then frankly, it's up for grabs in the next election cycle. And it does seem like even regardless of all that, there's sort of a shift saying, where can we make money? And to your point, if everything's not high, I'm hoping that the business is we're not seeing massive high yield of people getting the money there. But in many ways, it could be a bit like the housing sector, which did become more resilient on the back of crises, and that the folks that emerge from it are in a healthier position. And that if you are getting capital, it's stricter capital from banks and stuff. So that's where I think people can sort of miss the resiliency of yeah, oil prices could drop. I mean, oil prices are too high, as we talked about in the beginning now. So could they drop $20 and everything wouldn't crater? I think the reality is in the US, yeah, they could. And we'll have to really navigate the next 6 months. But I just think those are exceptionally valid points that are not they're not well thought about, especially by a lot of the leaders in the space.
Oh, sure. Yeah, that was a lot of strung together thoughts, but yeah, that well said. Yeah, the yeah, I mean, one of the reasons we're at $88 a barrel or 89 today is because of these the lack of capital for a couple of years. I mean, it's a commodity, and and the most valuable commodity right now in oil and gas is the capital directed to oil and gas. And we probably that's overshot. There was probably too much capital chasing both in the private equity and in the public markets, inflating valuations. Up through the end of 2019, there was probably too much capital and too much, obviously too much growth. So that's not. We have 150 years of history in oil and gas markets or in the oil market, and I don't think don't think we'll ever hit that middle ground that we're all yearning for. So it is best to be flexible.
Well, those are fantastic comments. So we're hitting the 1 hour mark. I think we've given the listeners a wealth of information. You've tons of insight. I think a couple things I think I want to close with just the recapping is, we've talked about inflation. You really mentioned that it is very significant in the space. I think that's we're going to have to watch that play out over the course of the next few months to see where that really goes, both from I think a labor perspective. The skills piece that you mentioned, I think, is huge, of the ability to get the right people in there. And if that eats into efficiencies, because I do think, longer laterals, faster drilling times, which was critical, getting, the right drillers on these rigs and everything, faster drilling times and being able to drill faster wells, say in the Delaware, maybe different, in the Midland, but this all incrementally adds up. And these efficiencies have been huge over the past couple of years. So if we start seeing that erode, that's problematic. I think the resilient, folks sort of, we hear the ESG thing a ton. We hear people beat the drum and stuff, but I feel like I wouldn't say it's flipping by any means, but I do think it's a different story with some private operators. And, I am, really pushing folks in the space to really be leaders in the space, and own what they're doing, and not treat it like tobacco, and realize that you are producing oil and natural gas, and, frankly, for that matter, coal, that this is really important for energy and understanding the energy crisis in Europe and stuff. Like we now have the administration talking about, ramping up exports to Europe, and various means of what we can do. And that probably will continue, all the geopolitics aside. And I don't think the geopolitics stuff is going away anytime soon. And then I think lastly, you're just pointing to sort of the some of the resiliency in the space of capital maybe flowing back, investors maybe flowing back. And I think, but we started this podcast with, we started it talking about oil prices might being a little too hot, and what's causing the oil price, the strength in those oil prices and potential recession. So I'm not quite sure we're giving our listeners a clear cut answer, or whether or not they're or a rosy picture to go in with. But if you have any last thoughts, you're more than welcome. The floor is yours.
Yeah, ESG, you said about there's some things we should adopt and start contributing to the narrative and start pulling things off. And that a lot of these I don't want to call it a bubble, but just this movement, the ESG movement, it's just been so forceful. It's probably the theme of 2021 and probably this year as well. And being so, there's a lot of unintended consequences that are going to happen as a result of that, with just the sheer force and movement. Things happening, too fast, and markets can't adjust. So, but that should not stop us from being pragmatic about the things that actually do make sense. And I mentioned a few of them. It's minimizing flaring and our methane intensity, increase our water recycling, minimizing the seismic activity induced by saltwater disposal wells, things of that nature. We can do that stuff. This is stuff we can do, and we can do it profitably. And that ultimately will attract that nice big middle ground, that big investor group, institutional capital and investors, back into the space. And we have to own part of that narrative though, and then demonstrate it and deliver on our returns and promises.
I think
Be
that's
good stewards.
sorry.